Hey there, Erin Bradley, coming to you live today from Fairway Independent Mortgage, my Winter Park office in Colorado. And I want to talk today about something that I'm kind of passionate about, and that is debunking the myth that FHA loans are inherently bad, because they're not. So I'm going to try to keep it short because I'm not good at that, and anyone who knows me knows that. But there's three main points I want to talk about today, comparing the pros and cons of FHA loans versus conventional loans. And number one is the difference in the guidelines and what makes FHA loans a little bit more lenient and easier to get loan approval. Number two is the difference in the interest rates that you can get with the different types of loans. And number three is how the mortgage insurance is structured and how it varies with the two loans. So this is going to be mainly targeted to folks who have a smaller down payment or who are hoping to put down a smaller down payment. That doesn't necessarily mean that you only have a small down payment available. It may mean that you're choosing to put a small down payment towards your home purchase and keeping the other funds liquid, which I actually highly recommend that you keep your money available to you for other opportunities and investments and buying more real estate, because it's awesome. But anyway, this is also really important for realtors to know. We've been having issue in the last couple years where FHA buyers' offers are being turned down on the advice of the seller's realtor under the preconceived notion, the incorrect notion, that an FHA loan indicates that you're not a strong borrower or not a strong buyer. And I don't think that's the case at all. And that's what I want to touch upon today. So, sorry, I don't have a good hold on my phone here, but I need to get one of those, like, what are those things called? Like a selfie stick or something? Yeah, or a tripod. I need to do something so I can hold this thing steady. Anyhow, I digress as usual. All right, here's the deal. FHA loans are government-backed loans. Conventional loans are backed by Fannie Mae and Freddie Mac. And traditionally, FHA loans are going to have a little bit more leniency on certain things, certain risk factors like the size of your down payment, credit scores, the debt to income ratio, and other factors. And because they're more lenient, they have the mortgage insurance on the loan structured a little bit differently than on a conventional loan. And this is where there's a wrong idea that an FHA loan is inherently worse than a conventional loan, and that's what I want to talk about today. So FHA loans, mortgage insurance is required on every loan. So even if you have 20% to put down, and for some reason you're using an FHA loan, you would have mortgage insurance on the loan. As I've mentioned in other videos, mortgage insurance is simply we as the borrower are paying to insure the bank against ourselves defaulting on the loan. Because we're considered higher risk to the banks, higher risk of default, maybe because of our credit score, maybe because of a smaller down payment, et cetera, they require us to pay this insurance so that they're covered in the case of we, the borrower, defaulting on our loan. So on a conventional loan, if you put down 20%, there is no mortgage insurance. And so the other thing to know about the mortgage insurance on an FHA loan is that if you put down less than 10%, then there's a monthly mortgage insurance that's part of your monthly premium, and there's an upfront premium that gets added to your loan amount, and it's basically financed over the life of the loan. So people started getting upset because FHA loans, that monthly mortgage insurance is permanent for the life of the loan if you're doing less than 10% down. On a conventional loan, if you're doing any percent of down payment and you go with the monthly mortgage insurance option, then eventually at some point in the future, after you've paid down your mortgage balance to 78% of the home's value, it will automatically fall off when your loan balance hits 78% of what you purchased the home for. And with most investors, you can get an appraisal done if your home value has gone up significantly. Maybe you remodeled, or maybe just the values have gone up naturally. And on a conventional loan, you can basically petition to have that monthly premium removed because your new higher home value and what you owe on the loan, you've hit that 78%. And because FHA loans, the government made that mortgage insurance permanent a few years ago, a lot of people just kind of started ruling out FHA loans. But I'm here to tell you that FHA loan can be a great option for folks who are thinking about doing a smaller down payment on a home purchase. So just comparing some numbers, apples to apples, if you're a first-time buyer and you're buying a home and you want to do a small down payment and keep as much money in savings for emergencies and opportunities, and you want to do 3% down, for example, if you compare that with the minimum down payment on an FHA loan, which is 3.5% down, right out of the gates, even if you have perfect credit, your interest rate on the FHA loan is going to be a little bit lower, typically about 1/4%, than on a conventional loan. Additionally, if your credit score is less than 740, which anything above a 740 is considered basically perfect. If it's less than 740, every 20 points that your score drops from 740, so from 740 to 720, 720 to 700, and so on a conventional loan, your interest rate gets penalized, so it starts to go up. Additionally, on conventional loans, if you're doing 3% down versus 5% versus 20%, etc., at that 3% down, you're also going to get, your rate's going to be penalized a little bit. So you're going to get another hit to the interest rate. Then there's mortgage insurance. So on an FHA loan, it just is what it is. Whether or not you have a 740 credit score or a 680 credit score, the cost of your monthly premium and that upfront premium are going to be the same across the board. And in most cases, your interest rate's going to be pretty similar too. So like if you have a perfect credit score or you have a 640, you're going to get a very similar interest rate on FHA, where on conventional, you're going to see a significant difference in both your interest rate and the cost of mortgage insurance. So when folks come to us and they want to do a minimum down payment, even with perfect credit, you might be looking at anywhere from like $100 to $200 a month monthly payment higher on conventional versus FHA. And so then the argument becomes, well, I'd rather go conventional because the FHA monthly mortgage insurance is permanent for the life of the loan. But here's the thing, if you're going with a conventional loan with 3% down and you're paying that monthly premium, it's going to take typically anywhere from like 6 to 9 years before you realize the point at which you can get rid of that monthly premium. Unless you're like aggressively paying down your mortgage, tens of thousands of dollars to get it to that point that you hit that 78%. And the chances are, if you're buying your first home, a lot of folks don't end up owning the home for that long. A lot of times within 3 to 5 years, circumstances will dictate that we will move on, whether because the size of our family changes or because our jobs change or location or just priorities and preferences in general. So if I'm looking at apples to apples and I'm talking to somebody who's thinking about living in a house for maybe 3 or 4 years and their monthly payment could be $200 a month cheaper on an FHA loan, I'm going to recommend FHA all day long. And for anybody out there, if you're selling a home or you're a real estate agent representing a seller and you think that the FHA financing is an indicator of not a strong borrower, well, that's just not right, because the fact of the matter is they're going with the best option for them. And so I don't think that people should just discount FHA financing as inherently bad or representative of a weak buyer. The other thing is that because FHA guidelines are a little more lenient, it's actually often easier to get loan approval for some of these folks. So it's another false, notion that you're going to have a harder time getting loan approval on FHA versus conventional. It's actually sometimes the opposite. So FHA loans can be pretty awesome, and I don't think people should think that they're bad. When folks are going from that 3% down to 5% to 10% to 15%, then we start looking at where conventional can become a stronger option because of all the different ways of structuring mortgage insurance, which I'll do in another video. But that's my story. I'm sticking to it. Don't rule out anything till you get the numbers and get the facts. And if you're on the sales side, don't rule out that FHA buyer, because they could be awesome. They probably are. And if they're working with us, they're going to get approved. End of story. All right. We love you. We appreciate you. Thanks for trusting us. Have an awesome day.